Hello, my name is Shreyans and today we are going to do a basic financial analysis of a leading auto company of India. But before we start, very important to remember that this is not investment advice. The purpose here is just to understand the financial performance of the company so that we can decide whether we want to further research the business or not. Alright, so let's get started. The company that I'm talking about today is Bajaj Auto. As we all know, it's a manufacturer of two-wheeler and three-wheeler vehicles. In fact, it's probably the largest in India and one of the largest in the world as well. So it makes bikes, scooters, autos, and these kind of vehicles. All right. Now, before we go on to the highlights, which we'll come to towards the end, let's start with the financials of the company, right? So starting with revenue, EBIT, and PAT. And the thing to look here is that the growth is not very good, right? In fact, there have been a couple of years when the revenue, EBIT, and PAT have decreased as well. And if you look at the overall growth, the revenue has increased by just 1.8 times. So it hasn't even doubled during this period. The growth in EBIT is even lesser than the growth in revenue, and the growth in PAT is even lesser than that of EBIT, right? So growth here seems to be a challenge, and there have been few years where it has actually degrown, right? Now let's look at cash flows next. So first starting with the cash flow from operations. And a good thing here that we'd like to see is the comparison of cash flow versus profit. So if you look at the cumulative cash flows here, then these are about 30,300 CR versus PAT, which is about 36,600 CR. So it is not the best. We'll have to look at this from the industry standpoint as well, at that what are the industry averages, but this is roughly around 82-83%. So the cumulative cash flow, and cash flow starts from a lower base and ends up here. That is why you see that the growth here seems to be optically higher, and cash flow has obviously been more volatile than profit, but that is a given. With cash flow from investments, you can see that there have been continuous reinvestments into the business. There have been few years when there have been a lot of reinvestments. There have been few years where it has been slightly muted. And these are not just reinvestments into the fixed assets of the business, but also, keeping short-term investments handy, making investments, redeeming them, and stuff like that. So that is also going on here. With cash flow from financing, majority of this are actually dividend payments, right? So all the stuff that you see here, there've been a slight inflow and outflow of maybe borrowings or other financing items, but most of this are actually dividends, and the company has regularly paid dividends for the last 10 years. And we'll come back again to this point of reinvestment in dividends when we look at the highlights and summary. Okay, now looking at the balance sheet position of the company. So a very good thing here is that equity has grown by almost 4.5 times. So that is a very, very healthy rate, right? When the revenue has grown only by 1.8 times and the PAT has grown by only 1.4 times, but equity has grown by 4.5 times, despite paying a lot of dividends as well. And I think the reason here is because it starts with the lower base and it's continuously increasing. We might also want to check if there have been any fundraisers or not, but that's something we can look at later. The growth here at first impression looks very impressive. Now looking at current assets and current liabilities in conjunction, they've more or less grown in line with revenue, right? So revenue is about 1.8 times, current assets about 2.2 times. That's slightly higher, but still it's not something that's out of the ordinary. With current liabilities, actually, the thing here is starts with a very high figure here, right? So the current liabilities start with a very high figure and then they fall slightly here, and these have broadly been maintained. It was the highest at this point of time, right? So this is slightly different than current assets, which have constantly broadly kept on increasing, but current liabilities have been in a much smaller range, right? Non-current assets continuously they've kept on growing. So if you look at the growth in non-current assets, it's 3.3 times versus obviously a much lower growth in revenue, right? And that's just something that we look at when we analyze the capital turnover. Non-current liabilities, very, very limited, very good solvency position of the company, so to speak. So till this point, it was very much in a range. Here it has slightly increased, but I mean, it's still very immaterial compared to the equity position of the company, right? So that's what we've looked about the growth rates as well. If you look about revenue growth rates, then this year and these 2 years are probably the only years. So 3 out of these 10 years or 3 out of the 9 years rather, where the growth has been rather impressive. Otherwise, it's just been low single digits or negative growth, right? And similarly, if you could look at with EBIT, so 1 year here, 1 year here, 1 year here, and then probably 110% year here. And similarly, if you could see with PAT, one good growth here, and one good growth here. So this is the only cause of concern at the moment that we have, right? With cash flow, it's understandable. It's slightly more volatile than PAT. Equity, very solid growth. Assets, very reasonable growth. And this is only in the current year when it has degrown. Net working capital, quite volatile because current liabilities started with a higher base, and current assets kept increased a bit more, right? Liabilities, I mean, the growth is hardly relevant here, because it's been very limited. Current liabilities operating in a specific range, and non-current liabilities a very small number. Okay, now that we've discussed the financials and growth, let's move on to the metrics. And this is going to be quite interesting because of few things that are at play here, right? So starting with the return on capital. Return on capital, if you see, it's pretty solid, right? Although the trend is declining, because obviously when the company is much smaller, then it is the ratios seem to be better, right? So return on capital, return on equity, they start at a very high. They start at insane numbers. So to be honest, and then they have slightly declined. So if you look at the years here, so it was in the high 50s and 40s and in the 30s, and now it's in the 20s. So the trend is declining, but still, I would say even at this position, the return ratios are very solid, right? Even at a 20% range, 20% range, and here also 18 to 20% range. Here, that's pretty solid for return on capital and return on equity. The minimum return on capital is 20.5%, and the minimum here is 19.2%, right? So within the last 4 years, we'd say that they have been operating about in the same range. So maybe they could stabilize here up after the extremely insane numbers during these initial years, right? Now, let's try to break down the ROCE and ROE into the margins and capital turnovers or capital utilization. EBIT margins, they slightly declined here from starting with 18% going about to a maximum of 19.8, and then eventually declining to 16.2, which is also the minimum. And similarly, if you could see with PAT here, starting with 20.9, going to a low of 13, and then, coming up to about 16.3. Right, this slightly looks awkward because the PAT margin is higher than the EBIT margin, but that is I think mostly because of the fact that EBIT doesn't contain non-operating income and PAT does contain non-operating income, right? The trend has slightly declined, but it's still more or less, at least to me, it seems quite healthy if you have about a 16 or a 15% margin. So that seems good, right? Now let's look at the other element, which is capital turnover and asset turnover. And here also they start with very solid numbers in these 2 years, as you could also see with the return on capital and return on equity in these 2 years. But then it has broadly started to decline. And in the last 4 years, let's say that the capital turnover has settled somewhere around 1.25, and the asset turnover slightly above 1, right? So these 4 years, they, at least it seems to me, that they have stabilized as well. Broadly declining trend, that may be because of the fact that there's been the company has found it slightly challenging to grow, right? CFO to PAT, we have already discussed. I mean, we'll have to look at this versus the industry average, but not the most impressive cash conversion, and it might be due to the industry or it might be due to other reasons as well. Now, net cash flow, this is a very interesting thing which we'll come back to. But first, let's discuss the solvency position and the liquidity position. So net working capital, as we discussed, volatile because current liabilities are starting from a higher position, current assets consistently increasing, and hence that you see. But broadly, this is more or less be in line with the revenue. So no problems there. Assets upon equity, the financial leverage, so to speak, continuously declining because there's hardly much of debt there, or hardly much of current liabilities, or even non-current liabilities for that matter, right? So it is at its lowest. Okay, so the lowest is here, but it's pretty much near to its lowest. So in the last 4 to 5 years, it's been very minimal, right? Non-current liabilities to equity, as I mentioned, hardly any non-current liabilities, hardly any sort of financial leverage, which could be problematic here. Okay, now I want to discuss the net cash flow position of the company. right? So this is the interesting thing here. If you look at the cumulative cash flow from operations, that's about 30,340 CR. And if you look at the outflows of investing, which are the reinvestments into the business majorly, and the cash flow from financing, which is majorly the payment of dividends, right? So this is slightly greater. The sum of these two is slightly greater than this, about 300, 400 crores, right? Now, this is a game of cat and mouse, whether you can think that the company is not reinvesting enough, that is why it is unable to grow, or if the company is unable to grow, that is why it is paying majority of the profits as dividends. And I like to go with the latter one. My understanding here is that the company is smart enough to understand when it has opportunities to grow or when it doesn't have opportunities to grow, right? And because any company that has any opportunity to grow, they would obviously choose to grow rather than paying out very high dividends, right? And if you see, then a lot of difference is just due to this 1 year, because from 2000 it's almost tripled. And if you also look at the breakdown of this cash flow from financing and look at the dividend payments, they have also tripled, right? I don't expect this to continue in FY21, at least such high dividend payments, because it would be interesting to see if the company, what level of revenue does the company is able to reach because of the lockdown and everything, right? So my understanding here is that company doesn't have a lot of amazing opportunities to grow. That is why it is investing in a very prudent manner, and it is paying out a lot of profits as dividends. All right, now let's quickly wrap up with the highlights. So as we've seen, struggle to grow revenue, EBIT and PAT, and also PAT growth has been lower than EBIT growth, which has been lower than revenue growth, right? Cash conversion not the best. Cumulative cash flow is only 83% of the cumulative PAT, as we pointed out earlier. And this is what my understanding of the cash flow, net cash flow is, that due to low or poor growth, which leads to limited reinvestment opportunities, the company has been paying out a lot of profits as dividends, and it has paid dividends consistently for the last 10 years. So that is one plus point as well, right? On the other side. Now, equity has more than quadrupled. So the equity growth here is 4.5x versus a very, very limited or even, insignificant growth in non-current liabilities. So very strong solvency position. Current assets, current liabilities have grown broadly in revenue with slight volatility, which I've already explained, right? Very good return ratios, return on capital and return on equity, although the trend is declining, but I think it has more or less stabilized in the last 4 years. Let's see how it performs next year. EBIT and PAT margins have broadly been maintained. Again, a very similar story, right? There's not a lot of volatility. There's been slight volatility, but not something that is altering ROCE or ROE very highly. So margins have more or less been maintained, and again have been stable over the last 3-4 years. Capital turnover, asset turnover, I think this is again, they have stabilized in the recent 4 years, but they have been the lowest as well in the recent 4 years. So that is probably something to look at to understand how this continues, because if there is further deterioration, then it might impact the return on capital and return on equity ratios. Till this point, it's still the company's producing more revenue than its capital base, and even more revenue than its asset base. So that is a good thing. So my conclusion or my understanding of the company is the fact that it has very healthy financial position, very good return ratios, but the problem here, in fact, good margins as well, but the problem here is growth, right? So it would be very interesting to see that how the company can bring about its growth, whether it goes into new markets or if it acquires greater market share. But I think the growth here is playing spoil sport for an otherwise very healthy financial company, right? And just to wrap it up, I want to also share that it is not just one of the leading manufacturers in India, but one of the leading manufacturers of the world, and it exports as well, right? So yeah, very good financial performance, very good financial position, but the challenge here is the growth. If the growth can come back, then I think then it could be a very good sign for the company as well. So that is all that I had to share about this particular company. If you found this helpful, then please let me know. If you want to discuss anything further, then you can drop in a comment. If you want to take a look at this worksheet, or if you want to sign up for more of this investment analysis, you can find the links to both of these things, to the sign up form and also to the Excel workbook in the comments, in the description below. So that is all that I had. If you found this helpful, please share this with someone who loves financial analysis. and subscribe for more. I'll see you again with another with financial analysis of another company. Thank you so much for watching.